Good afternoon, everyone. My name is Andrew Castleberry. Welcome back. Today we are going to be doing episode 3, Saving and Investing, part 3. So if you have been following this series in any way, shape, or form, we've really been trying to just cover a lot of the basics of investing. So if you're just getting into it, you're just starting to try and figure out your financial life, really plan out your financial life, what we've been going over, especially in this episode, is what savings and investing look like. So if you want to go to the first two parts of this episode, what we covered was essentially different types of savings and also different types of investing accounts. So what accounts you would use in different situations, 401ks, brokerage, savings, IRAs, what those look like. Today, we're going to be talking a lot more into how you invest your money inside of those accounts. Now, we're pretty much going to be talking about investment related accounts just because when you look at a savings or a checking account, it's cash. You're putting cash in there. That's pretty much all you're going to be doing. But what we'll be talking about is the different vehicles in which you can invest in those accounts. So we're not going to get into the technical, how you do it, how you place trades, what that looks like, more just what options are available to you, and then when they might be kind of used or how you would use them at that point. So we'll kind of start off with the most common ones and then branch into some that are a little bit more specialized or a little bit less frequently used by most people. So the two big ones that are going to be the foundation of most everyone's investing are going to be stocks and bonds. So stocks and bonds are going to be individual holdings that you are going to purchase in your investment account. So either in a brokerage account or a retirement account like an IRA or a Roth IRA, that's typically going to be where you see those. So when you buy a stock, we'll talk about stocks first, they are going to be individual shares of a company. So you are buying an individual ownership in a company. So if you were to buy, say, a share of Coke stock, what you are actually purchasing is a ownership stake in Coke. And what you are hoping for and what you are looking for when you purchase that stock is you want that company to do well. You want that company to do better next year than it did today because you want the value of that stock to go up. So stocks are typically your more risky of the two between stocks and bonds. They are a lot more volatile. They track whatever that company's stock price does. But the main goal and the main kind of driver behind that stock price, at least long term, is going to be what is that company doing? Are they growing their earnings? Are they growing? Are they already a larger company? Do they pay dividends? That's what you're looking at, but you're actually buying ownership. So a lot of people, when they think about investing, they might own like a mutual fund, which might be a collection of stocks we'll talk about in a second. But I find I have a lot of conversations where people kind of don't understand what the basic idea of a stock is. So they think the risk level is it could go to zero or something magical might happen and change the price of it unrelated to anything else. When in reality, in order for a stock share to go to zero, essentially, the company has to go out of business. So there is different levels of risk. If you buy maybe like a really small startup company that is really new and just on the edge of growing, they might go bankrupt. I mean, lots of companies go bankrupt every single year, and it's a riskier stock to own. So like the difference between buying a share of Johnson & Johnson and buying a share of the up and coming biotech stock are very different from a risk standpoint, but you're still buying ownership in that company. It's just risk dependent on what you're owning. So there's a very low risk of Johnson & Johnson surprisingly going bankrupt because they are such a big company. And even in recessions, people brush their teeth, they buy soap, they buy day-to-day goods. It's just something that you almost have to do at that point. But that's the basic idea behind a stock. Now, the basic idea behind a bond isn't that you're necessarily buying ownership in a company, but you are buying the debt of a company. So it's still based on the value of the company. Can the company pay for that debt? But you're almost becoming a lender. So the very basic level for a bond. And I say this knowing there's not a lot of cases where most people buy individual bonds. When people talk about purchasing bonds, they're usually talking about it inside of a mutual fund, which is slightly different. But an individual bond is you are becoming the lender for a company or a municipality or a country of some sort. So let's just talk about Johnson & Johnson again. Say Johnson & Johnson wants to raise money. So they're like, all right, well, what are we going to do? We're going to take out a loan. So that loan is a bond. They're going to issue bonds and say, all right, we're going to raise $1 million. So they'll issue a bond and they'll say, all right, we'll sell these bonds. You might buy one. So I might buy a bond for $5,000, which means that $5,000 is going to Johnson & Johnson. And they're saying, hey, we will pay you back over 3 years with 3% interest. So as long as you hold the life of that bond, you are locked in at 3% interest rate and you get your $5,000 principal back at the end. So they'll pay you 3% a year for that 3 years, and then you'll get your $5,000 back. It's kind of like a mortgage where you're paying a mortgage plus interest, and at the end of it, the bank gets the mortgage amount back plus all the interest that they loaned you, but you're the bank in this scenario. So the risk is if Johnson & Johnson goes under, well, they can't pay your bond back and you lose out on that $3,000, but you still got some interest, or that $5,000, but you still got some interest. Now, in reality, that's not how most people buy bonds. The bond market is complex, to say the least, but it is one of those things where more commonly than not, people will buy bonds in either a mutual fund or an ETF. Now, a mutual fund and an ETF are both financial products or instruments that package together either a large number of stocks or a large number of bonds or a combination of bonds and stocks together to kind of spread out the risk a little bit. So you could maybe say, I'll buy a share of an ETF that is a total bond market ETF, and you're buying thousands of individual bonds, or a total stock market ETF that's buying thousands of individual stocks, but you're just having to buy one share. So when people buy bonds, you typically see it more often than not in a fund scenario, just because it's much easier to buy a bond in a fund than it is to buy an individual bond, whereas it's a lot easier to buy it, or it's not easier, but it's about the same amount of effort to buy a stock as it is to buy a mutual fund. There's just slight little differences in the way the transactions are done, so most people end up not doing the individual bond route. Now, as far as mutual funds, that's probably the next most common thing that you purchase. Most people will recognize mutual funds inside of their 401ks, so their employer-sponsored retirement plans, their 401ks, and they might see target date funds, which are going to be funds that are set to a specific timeline. So if you were just starting the workforce, you might see like a 2065 fund. You might see funds that are specific to like a part of the market. So you might see a US large cap growth fund, which is going to be large growth related companies. So think Apple, Amazon, Microsoft. You might see a large cap value fund, which would be more value based companies. Think Johnson & Johnson, Procter & Gamble, maybe Walmart. You might see a small cap fund, a mid cap fund, maybe like a Domino's, something around those sides. And then you might see bond funds. So you might see like a U.S. bond fund or a U.S. corporate bond fund or a U.S. Treasury bond fund. So that is a fund that buys just Treasury bonds, so government bonds, or a bond that buys just municipal bonds, so like state bonds or just company bonds. So you have a huge variety of mutual funds that you can purchase. And what you're doing when you buy a mutual fund is you are buying into a pool. So you're saying take $100. Well, you have $100 and maybe that's not enough to buy a lot of stocks because you have to buy the shares. We'll assume in this scenario, you can't buy partial shares. So you have to buy shares. Well, you might say, well, Apple shares price, I think right now, if we look at Apple's share price, it today, as of 8/9/24 here, is $214. So if you have $100, you can't even purchase a single share of Apple stock, but you want to own it. So you might say, well, I'll buy $100 worth of a mutual fund, which you can do. And it will have, and you can say, I'll buy one that covers large cap tech. And it will have Apple, Amazon, Nvidia, Microsoft, Google, Facebook in it, and you can own Apple along with a handful of other companies by buying that mutual fund. Now, mutual funds still have risk, but they take away some of the single stock specific risk that you would have if you just bought Apple. So if something happened just to Apple, like a CEO left really quickly, or iPhones ended up suddenly all not working, so half their revenue just went away, that's a very Apple specific problem. So Apple stock might take a huge hit, but your mutual fund that owns Apple as maybe 5% of it won't take as big of a hit because you've diversified out your risk. And we'll talk more about diversification and asset allocation in our next video, but that's what a mutual fund is. It's a collection of companies that you would buy in. Now, the second way you can typically see this done, which has become a little bit more popular, is in an exchange traded fund or an ETF. So an ETF is, again, a collection of individual stocks or individual bonds or a blend of the two. But rather than being able to say, I just want to put a set dollar amount in, like $100, you can actually buy shares of it. So like one ETF, and by no means is this a recommendation, would be SPY. So it is the S&P 500 ETF by Spider. It is currently trading, I believe, $530 a share. So if you wanted to buy into SPY, you could buy all 500 of the S&P 500 companies. If you didn't have $530, there's another one that's called SPLG. It trades at $62. So again, if in that same scenario, you had $100 and you wanted to buy into, say, the top 100 companies, but that's not enough to buy individual shares of each one, you could buy into an ETF that does the same thing. Now, the big difference between ETFs and mutual funds is the way that they trade. I'm not going to get into the weeds of it here, but essentially one has a share price that you can buy during the market hours, and one just prices at the end of the day. Again, not a huge difference between the two. The lines are really getting blended, but those are the two you probably see the second most common between individual stocks and bonds. So most people, and I would say for most people, probably 90 to 95%, your entire investing life is going to be done in mutual funds, ETFs, stocks, and bonds. That's going to be it. You're going to have mutual funds in your 401k. You're going to have ETFs in your IRAs. You might buy an individual stock every once in a while. Some people might buy an individual bond, but that's probably going to be a pretty low portion. But that is the investing universe for, I'd probably say, 90 to 95% of people. Now, the next wave of what we're going to talk about gets a lot more specific. So now you're looking less at the broad kind of general public of just, hey, I do it to build wealth, to save for retirement. I want something that's a little bit steadier, a little bit more time tested. And it gets into, hey, I have a specialty somewhere, or I have an interest somewhere, and I want to focus on this subsect of the market. Because with stocks, bonds, mutual funds, and ETFs, they are broad enough. If you want to focus on like real estate or industrials or tech or biotech or financials, you can do all of that with stocks and bonds and focus your kind of investing strategy on a certain part of the economy, but do it through stocks and bonds, which is what a lot of people do. But the next couple of things are going to be a little bit different. It's going to be taking your investments and really starting to specialize them. So we'll start with real estate first. And I'm not talking about buying rental property. I'm really talking about buying real estate inside of a investment account. So you can buy REITs, which are real estate investment trust. A lot of those aren't very liquid. They invest in certain types of real estate like data centers or apartment complexes. They have their own different rules and regulations, so just be careful with it. You can also get a self-directed IRA where you can buy physical real estate inside of an IRA and have it be tax deferred. Now, again, that is a very specific thing with a whole laundry list of specific tax rules you have to follow. So it's not something you just want to jump into saying, oh, this sounds really cool, let me try and do it. You want to make sure you're working with a professional, and you're working with a professional that specializes in that type of transaction, because there are a lot of little things that can trip you up, that can cause a huge tax headache for you and take on way too much risk than you actually were trying to do. So real estate's one of them. You also have commodities trading. So if you wanted to say, hey, I want to buy oil or gold or wheat or anything that's a commodity at that point, you can buy commodities. Typically, you might hear them referred to as trading futures. that is a whole different complex market as well. It's not something to just kind of jump into, but it is a type of asset class that you can buy into. Now, again, with both of these so far, there's also ETFs and mutual funds where you can just buy those that are very simple to purchase and where you are paying for an active manager that is in that world to do the heavy lifting for you if you don't want to go specifically into those. So again, that's why I say most people are going to stick to ETFs and mutual funds for a lot of these strategies, because there's going to be those packages that are easy for an individual retail investor to use that's not going to have the complexity that it takes to trade or get into that world. Next is going to be collectibles. Again, ETF has a package for this, but if you are into collectibles, it's something you like and you want to hold the physical assets, collectibles is a way to build an investing strategy around. Then you have options trading at that point. So that is using leverage in a lot of ways to purchase individual stocks or take essentially bets either way. Again, it's a lot more risk than just holding an individual company. Typically does include taking margin, which is taking on debt to purchase something. Again, there are ETFs and mutual funds that use option strategies either for income or to get a little bit excess return using risk that might be easier for most investors. Then you're going to have cryptocurrencies. It's the last one I'm going to go over. So it's a little bit newer of an asset class, and most people have probably heard of it by now. It's pretty popular. If you haven't, you've probably been living under a rock. But it's a digital currency. Typically, you're not going to see these in a retail account at that point in time. Usually what you're going to be looking at is purchasing those through an exchange like Coinbase or like a Binance, something along those lines. You can, however, now purchase them in an ETF format. So a lot of investors will be doing that, buying either Bitcoin or ETH, so Ethereum, that coin as well, are both purchasable through an ETF, which you can do in a retirement account at that point. But again, reinforces the fact that mutual funds and ETFs for probably, I'm going to bump that to maybe 95 to 98% of investors are going to be more than covered using ETFs and mutual funds. But I hope this was helpful. Please check out our other videos. Really just wanted to provide a little bit of an overview of what you're actually purchasing, mainly because I've seen a lot of cases come into our practice and with clients I've worked with where you put money into an IRA and you think it's going to be invested automatically, but it stays in cash, and you sit back and like, it's been 2 years, it hasn't grown, what's going on? A lot of people whose only experience is working with a 401k, you don't necessarily know that there are different products or asset classes or things you have to actually purchase in like an IRA or a brokerage account. It's not automatic like a 401k is, where it comes out of your paycheck, auto purchases into a target date mutual fund for you. So I think it is really beneficial just knowing even the terminology on a high level of what you're looking for so that you can start getting introduced into how to actually purchase. But thanks for listening. Again, hope this was helpful. Please check out the rest of our videos and subscribe to the channel if you've enjoyed it. Thanks. Bye.